Hello everyone, welcome to ACCA P6 UK lectures brought to you by AccountancyTube.com. In this video lecture, we are still at residence. We will look at some more aspects of residence. So we determined residence, and we also now know that why residence is important in order to figure out who will be paying UK tax. Then we looked at remittance as well. So say for example, if you have any source of income outside UK and then you are bringing that money to the UK, that is remittance. And we have also seen the remittance basis charge. There was one type of remittance when you bring the money into the UK. So that is basically cash, when you bring the cash into the UK. Sometimes what examiner does is examiner asks that are there any other things which you bring into the UK other than cash? Will they be regarded as remittance? Now I want you to note down few things on your notebooks, please. Now these are the things which are other than cash. Now these things which are not cash, if you bring these things into the UK, then that will be regarded as remittance as well. Right? So of course, if you're bringing the money into the UK, if you're bringing the cash into the UK, that will be regarded as remittance. But there are a few other things as well which will be regarded as remittance as well. Now I want you to note down, please. Now when you have an asset outside UK, say for example, and you bring that asset into the UK, that will be regarded as remittance as well. So if you have an asset or a property, if you have an asset outside the UK, if you bring that asset into the UK, that will be regarded as remittance. Right? So that is one thing. Now say for example, if you have a loan within the UK, if you took a loan in the UK, and then you have to pay interest on that loan. Now you had some income outside UK, you thought that why don't I pay the interest with that money? So you are paying UK interest with the money which was overseas. So that is also known as remittance. So the money which you are paying the interest with, that money is you are paying the interest on a loan which was used in the UK. So interest paid, whatever the amount which you are paying the interest with, that will be also known as remittance. Right? So first one was that when you bring an asset outside you, when you bring an asset from outside the UK within the UK, that will be regarded as remittance. When you have taken a loan and you are using that loan within the UK and you are paying the interest or the capital amount with the money which was outside the UK, so you're paying to set off the loan, that will be regarded as remittance as well. There is another thing as well that will be regarded as remittance when, say for example, you are using some services within the UK and you are paying that services with the money which was outside the UK. So you are receiving them services within the UK, but you are paying for them services with the money which was outside the UK. Alright, so that will be regarded as remittance as well. Now if you come to page number 46 of your lecture notes, please. Employment income aspects. Sometimes what happens is that you are required to go outside UK for the performance of your duties. So say for example, you are seconded from one place to another, from the UK to any other country which is overseas country. Now traveling expenses which you have paid, so what would be the treatment if the employee is paying, and what would be if the employee is paying? Now these are the travel expenses incurred by the employee for duties abroad, as you can see on your video screen as well. Now travel expenses relating to employment duties abroad will be deducted, travel expenses relating to the employment duties be deducted from earnings as allowable deductions in certain circumstances. So these will be allowable deductions, but in certain circumstances. So what would that be? What would be the circumstances? A deduction is allowed for the starting and finishing travel expenses. So deduction will be allowed when you're going from outside UK, when you're going from UK to outside UK for the performance of duties. So that is first deduction which will be allowed, and when you're coming back to the UK, that deduction will also be allowed. Right? Now starting travel expenses are those incurred by the employee traveling from the UK to take up employment abroad, and finishing expenses are when you're coming back. Two conditions must be met. So the performance of duties must be wholly outside the UK. So duties of employment are performed wholly outside the UK, and the employee is resident in the UK, so he's only going to the outside of UK for the performance of the duties. Right? So this is when the employee is paying. It will be deduction. There will be deduction. It will be allowable deduction when the employee is paying only for the starting journey when he's going outside the UK and when he's coming back. Now it says that travel expenses borne by employer for the employee's duties abroad. When the employer pays, what would happen? Now there are a number of deductions which may be made from the person's earning. The allowable deduction will be equal to the amount included in the benefits. Now what would be the benefits? So the first deduction relating to the provision of travel facilities for a journey made by the employee. Employee is absent from the UK wholly and exclusively for the purposes of performance of the duties and his journeys from the UK to a place outside UK and a return journey following such a journey. So it is exactly the same thing which we have seen in our employee's case. So when you are going from UK to outside UK, so the first ticket which you're going from UK to outside UK and the return ticket when you're coming back from there. Now there is also a deduction for your family member as well. So family member include your spouse and your child who is under 18 when you are leaving the UK. So your child must be under 18 when you are leaving the UK for a job outside the UK. So he must be or she must be under 18. Now that either your family will be going with you when you're leaving the UK, either your family will be going with you, or if they're not going with you, they can't come the next day. So they will have to wait for 2 months before they can see you overseas. All right. So say for example, if I'm going from London to from here to Mumbai, say for example in India. So if I'm traveling from London to Mumbai, and either my family will be going with me if I want to claim it from my employer. Either my family will be going with me, or if they're not going with me, they can't come next day. They will have to wait for 2 months. Then they come to see me. In that case, that will be a deduction. All right. Otherwise, it won't be beneficial for the tax purposes. All right. So that's what it says here. And also remember that there are only 2 journeys allowed. So 2 outward journeys and 2 inward journeys, which means 2 return journeys are allowed. So 2 return tickets are allowed. Right? So that's what it says in the notes as well. So please make sure you read it. After that, it says the double taxation relief. Now, double taxation relief, as I said to you earlier as well in one of the videos, the double taxation relief is sometimes what happens is that I am paying tax on all of my sources of income within the UK. So I am paying tax on all of my sources of income within the UK. I am paying tax on all of my sources of income within UK, but some of them sources of income might be my overseas income. Now, whatever my overseas income is, I might have paid tax overseas as well on that income. All right. Now, say for example, if I have an income in France, and then I bring that money to the UK. Now first I paid tax on that income in France. Now then when I brought the money into the UK, then UK government is saying that you will pay tax again. So the same amount of money is being taxed twice. So when same amount of money is being taxed twice, then the double taxation relief will be able to help us within the UK. All right. So what does it say? Now sometimes, most of the time basically, there will be an agreement between UK government and the overseas government, which in my example was French government. So there will be an agreement between UK government and French government, which will say that this money has already been taxed within France, so please do not tax it again in the UK. So if there is an agreement between UK and the overseas government, then the amount will not be taxed twice. However, if there is no agreement between the 2 countries, there is no agreement between the UK government and the overseas government, then the double taxation relief will be given. Now the double taxation relief will be lower of the UK tax and the overseas tax. Say for example, if you have paid tax overseas at the rate of 20% and you have to pay tax in the UK at the rate of 40%, then you will only have to pay extra 20% because 20% has already been deducted. Right? So basically the relief will be lower of UK tax and the overseas tax. Say for example, if you have paid 40% in overseas and you have paid 20% in the UK, then it will be lower of these 2. All right? Right then, so if you just come up on your notes, so it says double taxation relief. The OECD, Organization for Economic Cooperation and Development, model agreement, which is the double taxation agreement, which I was referring to you again and again, that if there is an agreement between 2 companies, not companies, countries, if there is an agreement between 2 countries, then relief will automatically available. Taxation on a particular overseas income may be governed by an agreement in force among two countries. Then it says unilateral credit relief. If no relief is available under a double taxation agreement, UK legislation provides for unilateral relief. Foreign income must be included gross, so including foreign tax. So foreign income will be included, including the foreign tax in the UK tax computation. Then the double taxation relief is given for the foreign tax suffered. So how much tax we have suffered overseas, so the relief will be given. This is the credit relief. Now double taxation relief will be lower of the UK tax and the overseas tax, as I said to you earlier. So the UK tax on overseas gross income and overseas tax on the overseas gross income. Right, so it will be lower of these two. However, we will do a past exam paper relevant to this topic anyway. So then you will understand. Then you will understand it in a better way. But we will do it later when we have covered inheritance tax and the capital gains tax, because the double taxation relief is exactly the same for inheritance tax, capital gains tax, and income tax. It will be exactly the same. It doesn't matter that which tax it is. Double taxation, the way to calculate the double taxation relief will be exactly the same. All right, so we will do it in later when we have studied the other bits and pieces as well. Right, and after that it says, note that UK tax on the foreign income is the difference. And the UK tax on the foreign income is the difference between the UK tax before double taxation on all income, including foreign income, and then the UK tax on all income except foreign income. So it is a difference of these two. Right, so that's the end of our this chapter. We will do a question now. If you come to your exam kit, please. If you please open up your exam kit and come to question number 4. Question number 4 of BPP exam kit, and question name is Jodi. It was examined in June 2015 P6 exam. So we are going to do this question now. Now we only do part A and part B of this question. We won't be doing the whole question, which also include the capital gains tax and the value-added tax as well. So we won't be doing that. Right. So if we just read the requirement, in the requirement A it says, now this is a huge question, which is the typical question 1 of P6 exam, 35 mark question, which has a lot of information. Doesn't matter if it is a huge question or a small question. Examiner will always divide the huge question into small chunks. So you just have to read that relevant part, and then you can easily solve that paper. Right. So first of all, we have to read the requirement. So in the requirement it says, prepare the paragraph for inclusion in a letter from your manager to Jodi as requested in an email from your manager. The following marks are available. So this is basically guidance of marking. So first of all, it's UK tax resident status and liability to UK income tax. So we will do that part, and the relief available in respect of the trading loss, and that part. So we'll do only these two parts. Now with regards to A, the information is relevant, which is given in the above paragraph. If you see where it says prepare the paragraph for inclusion in the letter from me to Jodi addressing the following issues. So what are the issues? In part A it says UK resident status and liability to UK income tax. Now it says in part A1, assuming Jodi leaves the UK in accordance with her plans, explain how her resident status for the tax year 1920 will be determined, and conclude on her likely resident status for the year. To help, I've already concluded that Jodi will not be regarded as non-UK resident using the automatic overseas test, so there is no need to consider these tests. So it says in the question that I've already concluded that she is not automatically non-resident, so you don't need to do the automatic non-resident test. Alright, and after that it says state how becoming a non-UK resident will affect Jodi's liability to UK income tax. So if you're overseas resident, so if you become non-UK resident, how your liability, Jodi's liability to UK income tax will be calculated. Alright, so what would be the effect on that? Now we have to read the scenario. If you see where the question starts, where it says extract from the letter from Jodi. I've always lived in the UK. I plan to leave the UK and move to the country of Riviera on 5th of April 2019. So it's planning to leave the UK on 5th of April 2019. My intention is to move to Riviera permanently and acquire a new home there. So she's planning to leave the UK permanently and live there and buy the home there. If my children are not happy there after 4 years, I will return to the UK. So she is still not sure. She might come back, but for now her plans are to leave the UK permanently. Then it says, my husband died 3 years ago. My brother lives in Riviera and is the only close family I have apart from my children. So her brother is a close family member apart from the children. So and that too is living overseas. I will not have any sources of income in the UK after 5th of April 2019. So she does not have any UK source of income, which tells me that she's not working full-time overseas. She's not working full-time in the UK. She does not have full-time job in the UK. I intend to work part-time in Riviera, so she does not work full-time overseas either. So that I can look after my children. In the tax year 1920, I will return to the UK for holiday and stay with friends for 60 days. For the rest of the tax year, I will live in my new home in Riviera. All right? So that is the information which is given to us in the question. Now please open up your notes of your chapter residence and see that table. That table will be given to you in the exam, so that's why I'm asking you to open up so you can see that table, where it says that how many days you need to spend, and then how many days you need to spend to be considered UK resident, and how many ties you need. All right? So please open up that table. Now if you look at that table, because she intends to spend 60 days in the UK, so from 46 to 90 days, if you see in that table, 46 to 90 days in the UK. So if she is previously resident, which she is, then resident if 3 UK ties or more. So she is spending from 46 to 90 days in the UK, and she is previously a resident, so she needs 3 UK ties in order to be UK resident. Right? Now that is UK tie. Now before we move to the UK ties, we also need to consider automatic UK resident test. Now in the question it says, I've already concluded that she is not automatically non-resident, but she might be automatically UK resident. So we have to see that. Now there are 3 tests which are automatic UK resident tests. So what are automatic UK resident tests? One is a person is in the UK for 183 days or more in the tax year. Has she spent 183 days in the UK? No, she hasn't spent 183 days. So this automatic UK test does not apply. A person whose only home is in the UK, no, it doesn't apply either. A person who carries out full-time work in the UK, it does not apply on her either. So there are 3 automatic UK resident tests, and none of them apply on her in this case. So you will have to communicate to the examiner. All right. So first we will determine that she is not automatically UK resident, and on the assumption which was given in the question that she is not automatically non-resident, her resident status now will be determined with the help of sufficient ties test, UK ties test. Right? Now because she spent 46 to how many days? 46 to 90 days. In the question it says 60 days. So hopefully she will spend from 46 to 90 days in the UK. So if she spent 46 to 90 days in the UK, then if she is previously resident, then she needs 3 UK ties in order to be considered UK resident. 3 UK ties. Now what are UK ties? So you'll have to explain what are UK ties, and if them applies to her in this case or not. So having a family member, having a close family member in the UK is a tie. So does it apply on her or not? So it does not apply on her. She does not have any relative, any close family member in the UK, and she has only brother, and that is not a close family member with regards to the resident UK ties. So close family member means husband or the children, right? So husband is died already and the children are with her in the country of Riviera, so it does not apply on her. Second UK tie is having a house in the UK which is made use of. She does not have a UK house, so it does not apply. Doing substantive work in the UK 90 days or more, it does not apply on her either. Sorry, 40 days or more, it does not apply on her either. Being in the UK for more than 90 days during either of the previous 2 tax years. Now this applies on her because she was previously UK resident. So of course she would have spent 90 days or more in the UK. So this is a tie in her case. And then it says spending more time in the UK than in any other country in the UK, and then any other country in the tax year. It does not apply on her because she will only spend 60 days, which is on a holiday. Rest of the days she will spend in the country of Riviera. So she has only one UK tie, which determines that she's not UK resident with the help of sufficient ties, because she does not have sufficient ties. Right? Right then, so basically she is not UK resident. And in the question it says, which was part A2, it said that state how becoming a non-UK resident will affect Jodi's liability to UK income tax. Now, because she is non-UK resident, so she will only have to pay UK income tax if she has any income within the UK. So if she has any income within the UK, she will have to pay UK tax. On overseas income, she does not have to UK tax. She does not have to pay UK tax. Right, so that was the UK resident status and the liability to UK income tax. Now the second part, which is part B, relief available in respect of the trading loss. So we'll have to read the part B now. In part B it says relief available in respect of the trading loss. Calculate the income tax relief which Jodi would obtain if she were to claim terminal loss relief in respect of her trading loss. So calculate the income tax relief which Jodi would obtain if she were to claim terminal loss relief in respect of her trading loss. So she will claim terminal loss relief, which is the loss of the last 12 months of the trade, and the terminal loss relief means loss she can claim, she can carry it back to the previous 3 years on a LIFO basis, last in first out basis. Alright, and then there is no need to calculate Jodi's tax liabilities for each of the years concerned. So no need to calculate the tax liabilities. Just calculate the tax which will be saved due to the offset of the loss, and explain how you have determined this figure. So we have to calculate the terminal loss. So what is the information given to us? Now it's my unincorporated business. If you read that, please. I prepare accounts to 31st of December every year until 31st of December 2017. So she used to prepare accounts to 31st of December every year until 31st of December 2017. So what would happen after that? I then ceased trading on 31st of May 2018. So she ceased the trading then. I made a tax adjusted trading loss in the final period of trading of £18,000. So final period of trading is what? From 1st of January 2018 to 31st of May 2018. Alright, previously she used to make accounts to 31st of December. Now the last period of account is up until 31st of May 2018. So she'll be making accounts from 1st of January 2018 to 31st of May 2018, which are 5 months. Alright. And then it says, and there's a loss of £18,000 in the last 12 in the last accounting period, which are 5 months. There's a loss of £18,000. I attach an appendix setting out the information you requested in relation to the business, and then there is the information of selling the business and whatever. This is not relevant for this part. After that it says my sources of income for the last 5 years are as below. There is no property income in the tax year 2018-19 tax year because I sold my rental property in the May 2017. Right? Now, the information is given for the tax year 14-15, 15-16, 16-17 up until 18-19. Now, in the 18-19 tax year, if you see the trading income, it is nil. Now, whenever we have a profit, we will write down the profit amount. However, if it is a loss, we will write down nil amount. We will write down zero because it is not a profit, it is a loss. So when there is a loss in the trading profit section, we will write it down as zero. We know in the tax year 18-19 there was a loss, so that's why we did not write it down as a profit in here. Right? So then the previous tax year 17-18 trading income is given as £3,000, and the one before that £2,000, and in the 15-16 tax year it is £67,000. Alright? Now first we have to determine what? First we have to determine the terminal loss. Now we know that terminal loss is a loss of the last 12 months of the trade. Loss of the last 12 months of the trade, which means a net loss of the last 12 months of the trade. And I told you when we studied the terminal loss that it does not mean that we will take the profit and we'll set off the loss between that. That is the case, and that is net loss of the last 12 months of the trade. It's not like that. Terminal loss, we will divide that last 12 months into two periods. One is post 6 April and other one is pre 6 April. Then we will have to see if it is a profit, it will be 0. If it is a loss, then we will take the actual amount of loss. Alright, now let me cancel the shared screen with you so that we can do this question on the board. Right then, so first of all we'll have to calculate the terminal loss. And then we'll see the post 6 April. And which year is it? Post 6 April 2018. So post 6 April 2018, it was a loss, and there are 2 months only. So £18,000 times 2/5, because this is a loss of last 5 months. So we will only take 2 months because we are only taking the post 6 April only. So that's why we'll take 2 months worth of loss out of the last 5 months. Right? So that is a post 6 April. So whatever this figure is, let me do it on the calculator so that we can finish it off. So £18,000 times 2/5, £7,200. £7,200 is a loss. Right, so there is a loss, £7,200. Then we have to see the pre 6 April. Now pre 6 April, post 6 April, there are only 2 months. So pre 6 April there will be 10 months, pre 6 April. So in the pre 6 April there are 2 periods. One is a loss period, which is the period from 1st of January to 6th of April. So that is one period, and there is other period as well, which will be in the year ending 31st of December. All right. So in the pre 6 April, so that is from post 6 April is April and May, April to May 2018. So in the pre 6 April section, so first period would be from 1st of January to 31st of March 2018. That is first period. So in this period there was a profit of how much? There was a loss of £18,000 times 3/5. So that is how much? £18,000 times 3/5, and that is 10,800. That is a loss. And then there is then we have to take so these are how many months? 5 months. So then we have to take 7 more months. So 7 more months will be from June. So June 17 to 31st December 18. Right, so that's the period. Then in this period there was a profit in the question, which says which is given to us in the question. Just bear me 1 second. So it says in the question there is a profit of £3,000. So we'll take £3,000 times so these are 7 months, 7/12, 50. That is a profit, and then we have to net these two off. Now if we net these two off, because it was a profit in this period and it was a loss here, so if we net these two off, if it is a profit we will take it at 0. If it is a loss, we will take the actual amount of loss. Now chances are in this case it would be loss, so 10,800 less 1,750, so it is a loss of 9,050. Right, so that is a loss as well. Right, so we have divided the period into 2 different periods. We have divided that 12 months, last 12 months of the trade, into 2 periods. One is post 6 April and the one is pre 6 April. And if in the post 6 April or in the pre 6 April, if there is a net loss, then we'll take the loss amount. However, if it is a profit, then we'll take the amount as 0. Now in the post 6 April there was a loss of £7,200. We have taken that loss amount. And in the pre 6 April, because there were 2 periods involved, in one period there was a loss and in the other period there was a profit, and we have taken the net figure, net amount. If there is a loss, we'll take the actual amount of loss. However, if it is a profit, we'll take the if it is a profit, we will take the amount as 0. Then we'll add the overlap profits into it. Now in the question, in the additional information, the overlap profit is given. Now additional information, it says the Jodi's business has always been registered for VAT, so that is not relevant. And in the second part, it says that Jodi has overlap profits from the commencement of her business of £6,500. So we'll add the £6,500 into it. So that is a £6,500 of overlap profit. So that will be added into the loss. So overlap profit. If we add the overlap profit into it, so let's see how much is the total. £7,200 plus 9,050 plus £6,500, 22,750. That is terminal loss. Right, so 22,750 is our is our terminal loss. Now, excuse me. Now we have to tell that how we can set this off. How can we set off this loss? Now, 22,750 is the loss of the last 12 months of the trade, which is a terminal loss. We can first set it off against our current period. Then if anything is left, then we will set it off against the previous year and then the year before that. So 3 years on a 3 year on a LIFO basis, which means last in first out. So the latest one first, then the previous one and the one before that. Now if you see the profit figures which are given to us in the question, in the previous period, which was 17-18, there was a trading income of £3,000. Right, so this was a trading income of £3,000. But if you see the total income, which is 3,2,500 and 3,500, so altogether how much? 3 to 5, 6 and 3, £9,000 altogether. Now, excuse me, even if we do not set it off against the previous period, we are not setting off, we are not saving any tax at all, because in the tax year 17-18, the income was merely £9,000, so which was already covered by the personal allowance. So it is not beneficial if we set it off against the previous year 17-18. But if we want to set off against the year after that, then of course we'll have to follow this protocol. So we'll first set it off against the 17-18, then the 16-17, and then 15-16. So we'll set it off against 17-18. So if we set it off against 17-18, only £3,000 can be set off, and we'll save no tax in the tax is 17-18. We have to tell the examiner that why won't we save the tax, because the total income is just £9,000, which will be covered by the personal allowance. Excuse me. And if we see the year before that, which was 16-17, in that year the income is exceeding personal allowance. So if we exceed the personal allowance, then the tax rate is 20% for non-savings income. So we will be saving tax. We will set off £2,000 in that year, because the trading income is £2,000. So 3,000 in the first year and then 2,000 in the second year. So we will be saving tax at the rate of 20%. So 2,000 times 20%. Right? So 5,000 is already been set off out of this 22,750. So if we take 5,000 out of that, remaining amount is how much? 17,750. So whatever the remaining amount is, we will set it off against the tax year 15-16. Now it is a huge amount of money in that year. So it is a higher rate taxpayer. We will be saving tax at the rate of 40%. So whatever the remaining amount is, 3,000 plus 2,000, £5,000 out of this one. So remaining amount is 17,750. So the 17,750 at the rate of 40% will be saving tax in the tax year 15-16. Right? So that's how we will save the tax. So we have answered the part B as well, which says that relief available in respect of the trading loss. And in the question it's told me that we only have to consider the terminal loss relief. So I won't be considering any other loss reliefs because I'm restricted to calculate. I'm restricted to only the terminal loss relief. All right. Now, if you want to note down this question, please note down now, because that's very, very important for you to do so. After calculating this terminal loss, then you will have to write down the commentary as well, that we will set off 3,000 in the first year, but we won't save any tax because of the personal allowance, because the income is already covered by the personal allowance. Even if we set off, it was already covered by the personal allowance. Second year we will be saving tax at the rate of 20% because the income in the second year, the year before that, income was exceeding personal allowance. So that's why we will be saving some money. In the third year, if we look at it, in the third year we will be saving tax at the rate of 40% because the income was huge amount, so we'll be saving tax at the rate of 40%. So we'll have to tell examiner all of these circumstances, how we are calculating these figures and how much tax we are saving. So that's it for now. I will see you in the next video lecture, and just spare me 1 second. Let me grab the the exam kit as well. So just to tell you that how much we have covered so far. Just spare me 1 second, please. So if we check our questions. So first of all, if we come to question number 1 of your BPP exam kit, bail family, we have done this question, haven't we? Yeah, I asked you to do this question, and I asked you that I told you that we will go through together, but I have seen this question. It is very, very easy, basic question, so I don't need any revision of that. So I hope that you have done this question. If you have any problem, just drop me an email. So it was a very, very basic question. All right, so if you still have any problem, just drop me an email. Now in the question number 2, which is Stella and Maris, we have done that question, haven't we? Yes, we have done that. Piquet and Brocco, we have done that question as well. Question 3. Question 4, Jodi, we have just done that. Question 4, Jodi. We haven't done the question 5 yet. We will do that when we have finished with the inheritance tax as well, because it is capital gains tax and inheritance tax along with trading losses. So we'll do that later. Question 6, Monica and Honor, we have done that question as well. And then the question 7, Kat and Ravi, we have done that. Question number 8, Simon, we have done that one as well. And question number 9, Shuttle, we haven't done this question. So what's your homework? First, your homework is to redo this question, understand the logic and everything. Just write down. When I say redo, it doesn't mean that just rewind it in your mind. Just write down with your hand. All right. Then do the question number 9, which is Shuttle. We haven't done this question, but it is easy question. I hope that you will be able to do that. It is a good practice question. We have covered everything which is part of this question. So I want you to do question number 9, Shuttle. After doing this question, you will do question number 9. Right? So after doing question number 9, so we have covered almost everything in our income tax section of the questions. So you will redo all these questions which we have gone through. We have left few parts of the questions which were not relevant to us yet. Say for example, capital gains tax or inheritance tax. So when we study them parts, then we will redo some of these parts as well. All right? Or you will be able to do them. So that's it for now. We have covered our income tax. I will see you in the next video lecture, and then we will see capital gains tax. All right? But don't forget that you have to do these questions which I've indicated. So we've done almost everything in our income tax as far as this exam kit is concerned. I will see you in the next video lecture, and we will continue with our journey of advanced taxation. Goodbye.